You're still watching Good Morning Nigeria on the network service of the Nigerian Television Authority, the NTA. Now to set a tone for our discussion this morning on the proposed bank recapitalization by Central Bank of Nigeria. Oyeyemi Ajayi has put together this introductory package.
Bank recapitalization means reinvesting in banks with new capital to improve their balance sheets. The recapitalization becomes necessary when bank liabilities are higher than their assets. The liquidity with banks is a liability, as it is the money deposited by customers, which needs to be paid sooner or later. Due to this, their balance sheet weakens and banks find it difficult to raise capital from the open market. And this is where the government, also referred to as the biggest shareholder, can infuse capital in banks by either buying new shares or by issuing bonds. In 2004, the then governor of the central bank, Professor Charles Soludo, introduced measures that will reduce the exposure and enhance the stability of the nation's financial system in order to strengthen and reposition the existing banks and putting new ones on a good startup. This was why 25 billion naira capital base was injected from 2 billion naira. This resulted in the fold-up of some banks and merging of others, renewing the confidence of customers and investing on Nigerian banks. This action was seen as the right step, believed to have transformed the country's banking sector for the better, stabilizing the country's overall economy. 15 years later, talks about recapitalization is resurfacing. At the recent media briefing, while reading out plans for the next 5 years of his second tenure, the governor of Nigeria's Apex Bank, Godwin Emefiele, echoed the need for recapitalization again, saying the Nigerian banks need to be among the top 500 in the world. Emefiele said that then bank recapitalization has been weakened and therefore the need to reposition the Nigerian banks becomes imminent. Now, with this plan, where does it leave investors, customers and shareholders of banks? How does it affect the overall economy? And are Nigerians to expect another tsunami of banks merging, with some folding up? Guest on NTA's Good Morning Nigeria will be providing answers shortly.
Thank you very much, Oyeyemi Ajayi. We have our guest seated already. We'd like to welcome to the studio. Professor Uche Waleke is the chairman, Chartered Institute of Bankers of Nigeria, the Abuja branch. Welcome to the program.
Thank you. My pleasure.
And we have joining us from our Kaduna Center, we'd like to welcome Dr. Zubair Tajo Abdullah of the Department of Economics, Kaduna State University. Dr. Tajo, welcome to the program.
Thank you very much. Good morning, Nigeria. Good morning to you too.
All right. We also have guests at our network centers that will be joining us in the course of the conversation. We hope we clear the lines to those centers. Well, let's begin with Professor Uche Waleke, of course, who's a regular guest on Good Morning Nigeria. Our background report did touch on recapitalization. Let's break it down to the benefit of some of our viewers. Recapitalizing means that you already have capital. What is a bank's capital, and why is it necessary for the CBN to keep an eye on the capital of a bank?
Yes, thank you very much. When you say capital, of course you mean you could say the money that the bank is using, to act as a buffer. And that capital is usually contributed by the shareholders. So we have ordinary share capital, okay? And when the central bank talks about recapitalization, the central bank is not just focusing on capital. That's share capital. The share capital can, of course, be of different forms. You have ordinary share capital. You also have the one that's called preference share capital, okay? And it's not just the share capital that the central bank is really concerned with. The central bank is concerned with what is called shareholders' funds. So shareholders' funds is a composition of not just the share capital, but also the reserves of a bank. So your capital plus your reserves, should be up to a certain level for you to be able to function properly. Remember, banks are in the business of financial intermediation. They mobilize funds from what we call surplus units, and they channel to deficit units. Okay, in other words, they get funds from savers and they use those funds for lending. So traditionally, that is the main function of a bank. And for a bank to do that, seamlessly, okay, for a bank not to have the temptation of, making away with depositors' funds, because deposits with the banks are obligations of the banks to their customers. The bank needs, that bank needs to have sufficient buffer, sufficient capital to be able to withstand any shock. And that is why there is need to, increase the capital base of banks, okay, to make sure that the bank is in a position to do that. And if a bank doesn't have enough capital, the bank again is not in a position, is in a weak position in terms of lending. Because there is what is called, for example, the part of the prudential guidelines is what is called the single obligor limit. It's one of the risk management tools that the central bank puts in place. Single obligor limit means that there's a limit to the lending that you can do. So today it's about 20%. So if a bank's capital is, say, 30 billion, remember I talked about share capital and reserve. So if the share capital is, say, 25 billion, the minimum, and you have reserves of 5 billion, that means the shareholders' funds is 30 billion. Okay, what you can lend is subject to 6, from what I've just described now, 6 billion. So if your share capital and reserves is 30 billion and single obligor limit is 30%, that means the maximum you can put out there is 6 billion. And look at it in today's Nigeria, what projects can 6 billion really finance? Okay, we are talking about banks that should be in a position to finance development projects. 6 billion, if you take that in dollar terms, because most of these development projects are dollar denominated. So if you take that in dollar terms, it's really small. So such a bank may not be in a position to finance projects, big ticket projects in, say, the oil and gas sector, in, say, the telecom sector, in, say, the power sector. And these are sectors that, were required to drive growth and development, in the economy. And what usually happens is a case of where a bank is unable to do so. You find banks syndicating. And of course, loan syndication comes with its own costs, associated costs. It's more expensive. There are delays associated with it. So it's better for our banks to be, strong. If you look at the situation in 2004, recall that in 2004, in July precisely, the then CBN governor, Professor Charles Soludo, also came up with this consolidation. Okay, what was the background at the time? We had tiny, fragmented banks, all over the place. 89 of them, that couldn't really make significant contributions, in the economy. So Soludo came up with this policy. So at the end of the day, over a period of 18 months, by December 2005, we had 25 banks that were stronger. The same situation is also playing out now. Okay, you have a banking sector where just a few banks control, say, over 70% of bank assets. If you take out the big 5, okay, if you take out the likes of First Bank, UBA, Zenith, GTB, okay, and Access. If you take out these first 5, you can see that the banking sector, collapses. So from that fragmented structure to a bigger structure where you have banks that can rank, at least internationally, that can compete in the international space. If you look at the ranking of banks in the world, there is no Nigerian bank that ranks among the first 500. Okay, I want to even quote the CBN Governor Soludo in the speech that he made. None. There's a single bank in South Africa, the South African Standard Bank, okay, has assets that, if you compare the assets of that bank to all the ones we have in Nigeria put together, that one alone is greater than the ones we have in Nigeria. So in a situation like that, our banks cannot compete internationally. And that's why, in my view, I think what the central bank has done, the central bank is not saying, as we saw in the last time, over a short period of time, the central bank is saying over the next 5 years. So it's just a signal. It's just for you to begin to get ready, to prepare. And let me also say this. What I'm going to say is evidence-based, because I've had the privilege of supervising many, some, MSc, PhD work, on this matter. Because since 2005, we've had a number of studies on the impact of consolidation, on the banking sector. And following the ones I've supervised, I can tell you that the preponderant view is that consolidation has really helped to bring about stability in the financial sector. And usually what they do, quickly, is to look at pre-consolidation period, post-consolidation period, and look, spotlight a few financial indicators, such as non-performing loans, cost-to-income ratio in terms of efficiency, return on assets. Okay, so they look at include capital adequacy ratio. So they look at all this and then come to the conclusion that it has really, yes.
All right, thank you very much, Professor Waleki. Yes, well, let's get back to our Kaduna Center, where we earlier introduced Dr. Zubair Tajo Abdullah. It will appear 15 years after we had the last recapitalization for the financial sector, that's the banking sector, the fragility as well as the vulnerability is not ready to leave the sector in a hurry. What are your views?
Very much. As the honorable distinguished professor has indicated earlier, there were internal problems. First, with the value of money. You see, money has a time value. You have 1,000 naira today. Its value in the next 2-3 months will not be the same. So if you want to buy something, if you want the purchasing power of that 1,000 naira to be the same, it means 3 months from now, you have to increase a certain amount, because within 3 months, inflation would have done away with a significant part of the value of the money. So the purchasing power will not be the same. That is one particular reason that led to the erosion of the capital base, inflation. The second one is the naira-dollar parity. And as the central bank governor indicated in his submission, the fact of the matter was that during Soludo, when the last recapitalization commenced, the value of the dollar was about 100 naira. Now it is about 360 or 65 naira. And that is another source of erosion. So the very definition of recapitalization, implicit in it, is the fact that a return to the required capital base or former capital base, or an increase in the value of the capital base. This is it. The short history is that over the last 15 years, the Nigerian naira has lost a chunk of its value, partly due to inflation, and secondly due to the change in the parity between the naira and the dollar. Thank you.
Well, Dr. Zubair Abdallah, thank you for your opening comments, but I still want to stay with you before we come back to Professor Owaleke with us in the studios. Is the comparison in terms of the value of the assets of banks, say 2005 when the last recap exercise was done, versus what we are seeing today on account, one, of inflation, and secondly, the exchange rate of the naira to the US dollar. Are bank assets only in cash? We have also seen, for instance, that some financial institutions have assets other than cash, and those assets would have grown in value on account of the rise in inflation. A property that you acquired, say, 15 years ago, if you were to go to revalue it today, will certainly be several times higher. So what is the basis of comparison? Is it just merely absolute or what?
the accountants will take the nominal value. The economists will look at the effect of inflation on whatever the value of the asset is. Alternatively, you can look at the replacement cost. If you have invested 100 million in a project or in a building, an edifice, and 10 years on, its value has risen to, let's say, 150 million. Then, there is a gain. But by the time you take that 150 million and actually divided it by the rate of inflation, what will you get? That's another pointer or another partial answer to what you are saying. But it is true. Banks do have physical, tangible assets on the one hand, and they have also financial assets made up of loans, advances, investments, and the like. But these are the main sources of their income. These investments, loans, and advances, they are risk assets, but they generate a lot of income for the banks. Recapitalizing the bank will strengthen them for the future in terms of new investments, new loans to be granted, new opportunities, seizing new opportunities in other horizons within the economy, so that overall their profitability will be enhanced as a result of recapitalization, sir. I hope I am fairly clear. But if there is ambiguity, please straighten me up.
Well, I'll give the opportunity, Dr. Abdullah, thank you. I'll give the opportunity to Professor Uche Waleke to also respond to the question. Waleke, you understood the question that I asked. Yes. Namely, if banks have assets, the assets that they have acquired since 2005, obviously will also have grown in value. Banks also have investments, not just in Naira, but some of them have investments offshore. So if you were to dollarize all of this, I would therefore be looking at an absolute value to say, oh, the capital base is still 25 billion, or their shareholder funds is that much. I'm not sure whether the numbers have been done. That's why I'm asking the question.
Yes, thank you. If you look at it critically, it is not for nothing that the central bank would insist that the recapitalization route must exclude revaluation of assets. So when we say recapitalize a bank, the central bank makes it clear that is not about coming out to say that this building used to be worth 10 billion, now it is worth 20 billion, with a view to meeting up with the capital requirements. So the central bank clearly excludes that, and that's because that building you're talking about, that asset is not, you've not realized it. The major asset from where banks get their income is the loan, the risk assets. And that's why the central bank, part of the risk management tools it uses is the capital adequacy ratio. The capital adequacy ratio is the ratio of your capital to your risk-weighted assets, what is called risk-weighted assets. Those risk assets are loans, okay? That the capital that you have should be far more than the loans that you give out by, say, 10%, okay? Just the other day, when the central bank governor was reeling out his policy trust, he mentioned that capital adequacy ratio in the banking sector, today has, has shown some, improvement from 11% to about, in June 2017, to about 16%, okay? And he also talked about improvement in non-performing loan ratio, okay, from 15% to about 9% now. Now, the point is, if you look at those improvements, recorded in those performance indicators, they are mainly associated with these big banks. So there is still something about scale, okay? Many of the banks that are smaller in size, if you like, the tier 2, tier 3 banks are banks that are, known for these huge non-performing loans. Okay, so you find that studies have even shown that there's a strong correlation between scale and banking performance, because a big bank is in a stronger position to put in place, risk management measures. A big bank is in a stronger position to diversify, its assets. So if you look at the cases of corporate governance issues and many of these infractions, okay, you would find that they're associated with some of these other banks. So there is something about scale, no doubt. So when you talk about assets of banks, really, yes, there are. You could talk about buildings as fiscal assets, but loans and advances represent assets of banks. Yes, and as I said earlier on, the building, the bank building you're using for your operations, yes, of course, it's an asset, but it's not generating any, revenue for you, except you have leased it out or leased out, part of it. So the main thing remains loans and advances, and that is why when it comes to the issue of capital, when we say capital, we don't include those ones. We don't have a case of revaluation, and that is why the central bank says the recognized routes are either through mergers and acquisitions or through fresh injection of capital from the capital market. In 2005, if you recall, we saw significant improvements in capital market activity, following the recapitalization. Over 400 billion naira, I recall, was raised from the capital market. The primary market was very active. We saw a lot of IPOs. We saw a lot of rights issues, from banks. And over the next 5 years, okay, now that yes, I also foresee that happening because the market requires a trigger, and this is one trigger I see also, coming. So if banks can approach the market to raise more money, and those that cannot will submit themselves for major, arrangements, okay, that will be fine. The last time we met, I talked about a situation where, a bank can even identify, a smaller bank can identify a bigger bank, what we call in finance a white knight, a friendly investor to, to take it over. Okay, in 2004, when we had 89 banks, remember that not all of them, were part of the consolidation.
Exactly,
yes, some of them could not be, consolidated, but now we have, 20-something, it's manageable. So at the end of the day, if we have a few banks that are strong, that are even in a position to key into the central bank's overall vision of using the banking sector, to drive growth. Okay, it may interest you to note that I was looking at the last GDP report, by the National Bureau of Statistics. The finance and insurance sector contributes just 3%, to GDP. And of course, this sector is still in the negative territory. And the sector is, of course, dominated by the banking sector. So for the banking sector to make meaningful contribution to the economy, we need, stronger banks.
Professor Waliki,
yes.
You use the statement for those banks that will be watching out, okay, they're strong, through whatever the parameters are to judge the healthy status. Now, in order not to scare customers and also will be investors even in the financial sector, what determines the healthy status of a bank or the viability? So for people to watch out, at least as watchers in the industry.
If you deposit money in the bank, for a customer, you deposit money in the bank, and each time you go to pull your money, there is no story, or you approach a bank as a customer, you approach a bank for a facility, and you get that facility, okay, you tend to have confidence, in that bank, okay, because the bank is meeting your needs, as it were. So for banks to be in a position to deliver, that is the point I'm making, okay, to meet the expectations, of their customers, okay, those banks need to be, big and strong. If a bank is having liquidity issues, for example, okay, liquidity crisis, okay, that bank is likely most likely to find means of not rendering those services to their customers.
Okay.
Now, research has shown that only 10% of bank customers take advantage of many of the products that the banks make available. So for us to achieve our target of financial inclusion, for us to have robust payment system in partnership with fintech companies, we need banks that will have enough capital, enough money to invest in technology, to be able to do that.
Thank you very much, Professor.
I was wondering, Professor Waleke, I did mention that we're going to be joined by other guests from our network centers. This time we are going to our Benin Network Center, where Professor Michael Badan, another regular guest on Good Morning Nigeria, is joining us. Professor Michael Badan is a professor of economics and also a member of the Monetary Policy Committee of the Central Bank of Nigeria. Professor Badan, pleasure to have you with us on the program.
Thank you very much, Kingsley. It's my pleasure to be with you.
All right, straight away, I mean, we've been on the subject now for the past 20-25 minutes. Let's just back up a bit. In 2004-2005, when we had the last bank recapitalization exercise, it was almost used as a synonym that recapitalization was for the consolidation of commercial banks, because you had 89 commercial banks at the time. Some of them were no more than one building banks. You have found most of them on Awolowo Road in southwest Ikoyi. Now we later on had 25 banks. What is the purpose of the proposed recapitalization exercise moving on from 2019?
Thank you very much, Kingsley. I think the major aim of the planned recapitalization of banks is to strengthen the banks and reposition them to be able to perform their traditional function of intermediation. That is to say, serving as intermediary between the surplus funds unit in the economy and the deficit units. That is to say, those who have money and then those who want to borrow money. I see the planned action as a proactive and strategic move by the Central Bank of Nigeria. As the governor indicated, Governor of the Central Bank indicated in his press briefing, two major aims. One, to reposition, the banks and make them strong and big to be among the 500, banks in the world. And then secondly, to empower them, prepare them to be able to withstand any crisis, any economic crisis. In other words, perhaps, internal shocks, external shocks. And that derives from the central bank's appreciation of the importance of adequate capital, for banks. Capital is important or crucial for commercial banks, financial institutions. Actually, we cannot overemphasize the role of capital in the banking industry. Because of a number of roles which such capital plays, I will quickly outline them. Number one, capital serves as an essential element which enhances confidence and also enables, the banks to perform their traditional functions, within the industry. Very importantly, capital in a bank serves as a means of absorbing losses. I think this is very, very critical. Serves as a means of absorbing losses. In other words, capital serves as a buffer between operating losses and the issue of possible insolvency. And the more capital that a bank has, the more losses it can sustain. And actually, the more capital that a bank has, then the more time that it has to address internal weaknesses, to address lapses that would have created problems resulting in the losses which it incurs. And in addition, you will find that a huge capital base offers protection to both depositors and creditors in case there is failure in the banks or banking system. In other words, it protects depositors and creditors alike. It strengthens, huge capital strengthens a bank's ability, to assume risk. In other words, to provide loans and advances, to various sectors of the economy, particularly the real sectors of the economy. If the capital base is small or limited, then the ability of the bank to be able to do that, is limited. And a huge capital base also influences a bank's ability to attract funds, at low interest, rate. And very importantly, but not the least, is that when a bank has adequate capital base or huge capital base, it enhances the liquidity position, of the bank. Once a bank is in a good liquid position, it has adequate capital base, then it can easily perform the traditional functions that we as stakeholders expect banks to perform. So essentially, the proposed recapitalization of banks in Nigeria is a strategic move, is a proactive move by the Central Bank of Nigeria to strengthen the banks, put them in a position to be able to perform their financial intermediation roles in a very effective and satisfactory manner.
All right, thank you very much, Professor Michael Badan. We'll get back to you in the course of the discussion. Now, let's bring on Mr. Johnson Chukwu. Johnson Chukwu also is a financial analyst and is joining us from our Lagos studio. Good morning to you, Mr. Chukwu.
Morning.
Your view, yes, the recapitalization 15 years on, and there are the high moments, and also there have been some other off moments for the financial sector. What are your views about the proposed recapitalization, and what do we need to do differently this time around?
For me, my take is that we need some level of clarity, from the CBN governor by the time the Board of Governors meet and come up with a clear guideline on how the capitalization will take place. In the first place, the banking industry in 2004 is not the same banking industry in 2019. The banking industry in 2004 was fragmented. We had 89 small banks who could not actually have the financial capacity to engage in material lending. And that compelled the then central bank governor to come up with a guideline requiring banks to have 25 billion capital base. And when you talk of capital base, remember you're also talking of reserve. So for me, I need to look at what exactly the central bank wants to do. Is he going to come up with a one-size-fits-all that was done in 2004, where the central bank decreed a 25 billion across board? Or is he going to adopt modern banking supervisory strategy which requires risk-based supervision and which requires banks to carry the capital base that will meet their risk profile? Today, you have among the Nigerian banks that have shareholders fund of 491 billion like Access Bank. You have a bank like Zenith Bank that has shareholders fund of 816 billion naira. If you look at Zenith that has 816 billion naira in shareholders fund, we are talking of a capitalization of about $2.2 billion. The top 6 banks in the country all have shareholders fund in excess of $1.3 billion. So if we talk of recapitalization, I need to look at how the central bank wants to approach it. I do not imagine that the central bank will come up with a one-size-fits-all and say, look, you now need to have 50 billion or 100 billion. The reality is that in as much as you want financial system stability is not only driven by share capital. A lot of other factors have to also come in. Today, after the consolidation, we saw failure of banks subsequently. At the time of consolidation in 2004, the thinking was that we're not going to have any failure. But subsequently, we saw failure. We know that several banks were eventually currently out of the market, or went out of the market because, one, they had very severe level of bad loans that led to their inability to meet obligations. They suffered liquidity crisis, suffered solvency crisis, irrespective of the fact that they were all capitalized to the tune of 25 billion. So for me, the most important thing is that we must have a risk management framework, a supervisory framework that will ensure that each bank that operates within the economic space has enough capital to meet its risk profile, to meet the operating activities. If we want to adopt, in other countries, other climes in the world, you have the big banks, the very big banks. In the world today, you have global banks like Goldman Sachs, Citibank, but you also have smaller banks that are niche players in the market. So what I want us to have in this economic space is that we should have banks that fit into different market segments. You have the small banks that are niche players. In America, you even have family banks that actually focus on the localities, like close to what we have as microfinance banks. And those banks are state banks. You have state banks, you have regional banks, then you have banks that have global standing. So if we have to encourage free market enterprise, we should allow for free entry, free exit. Those banks that are not able to meet their obligations, that have lost their liquidity, are no longer solvent, should be taken out of the system, should be taken out of the system in an orderly manner, while as we create space for people to order new banks to come in, like what the central bank has done recently. I know central bank licensed new banks, and those new banks, some of them have started operations, they are winning customers. The key thing for me is that we must not close the window for entry in the competitive space. Otherwise, we will stifle competition, stifle innovation. If you cast your mind back, the banks that we are calling big banks today, the likes of Zenith, the likes of GT Bank, the likes of Access Bank, I mean modern Access Bank when I talk about Access Bank. If you take, for instance, Zenith and GT Bank, Zenith started in 1991. The top big banks then were Union Bank, First Bank, and UBA. Today, Zenith has more capital base or shareholders fund than those other three banks. In fact, Union Bank is even in a region of 220-something billion naira in shareholders fund, which is less than a third of what Zenith has today. Because there was a banking space that allowed new entrants. At that point, the Zenith Bank, the GT banks of this world, they were considered very small banks. They grew over time and they become the largest banks in the country. So we must leave a window for new entrants without coming up with a capital requirement that will make it impossible for new entrants to come into any economic space. And that's, for me, the concern. So the central bank, in coming up with a detailed guideline, should ensure that it's risk-based and not necessarily one-size-fits-all. Otherwise, you will be shutting out new entrants, you'll be shutting out creativity, you're shutting out innovation in the economy. And interestingly, in most environments, it is the new startups that come up with innovation, which is what happened in the banking industry. If not for the entrance of the likes of GT Bank, Zenith Bank, Citizens Bank, Diamond Bank of those days, today we would have still be going to the bank with a mat. But those banks came and revolutionized service delivery. They were a small bank, they were looking for a niche to compete, and they looked at service quality as a competitive edge. And they now arose the giants to reform. If you shut out new entrants, you will kill innovation. So the central bank, in looking through or thinking through the process of recapitalization that you're going to come up with, the guidelines you're going to come up with, must be conscious of the fact that we must not stifle competition. We must allow for new entrants into the space. And to maintain financial system stability is not just about maintaining strong shareholder capital base. You must also have an economy that is expanding. You must have an economy that is creating opportunity for the banks to lend. You must have a sound regulatory framework that can nib in the bud deterioration in asset quality. that has such a oversight role that will compel banks to abide by the best corporate governance standards. So if we have these things, we're going to have a robust banking space that will have the big tier, banks, the medium-sized banks, the family banks, but most importantly, everybody should have a space to enjoy financial service.
All right. Thank you very much, Johnson Chukwu, there for your opening comments. You talked about family banks. I'm sure that some Nigerians will feel very squeamish about a return to the era of family banks, banks owned by Mr. and Mrs. or Mr. and Mrs. and sons. Of course, there are new corporate governance guidelines with regard to the financial institutions that forbid such institutions such as family banks as we had in the past. But your points are noted, in addition, of course, to what used to play out in the 80s and early 90s when people were going to the banks with their mats and expecting their tally number before they were served. Now, Johnson Chukwu, you raised a number of important points. I would like Professor Mike Obadan to respond to some of those points, namely that have we had a studied evaluation of what went right with the consolidation of 2004-2005, and also what went wrong, and therefore appropriate lessons that could be useful for 2019 going forward?
Well, thank you very much, Kingsley. I know definitely some studies have, been done, and even when the policy in 2004 was announced, remember that some of us had done copious analysis of the policy and then brought out the implications and made suggestions on what could be done to make the recapitalization program at that time, to yield the desired results. I remember very well, I did a copious analysis, and the findings, were published serialized in a number of newspapers in Nigeria, including The Guardian, in which I drew attention to the fact that a recapitalization, huge capital base, for banks is very important. But that, I think I concluded that it's a necessary condition, but not a sufficient condition for the continued financial health, of banks. In other words, that banks can have huge capital base, but if many other factors were not taken cognizance of and addressed, then the huge capital base may not solve the kind of problems that were observed at that time. In other words, that a bank would have huge capital base, but if you have a reckless and inept management, it will squander the huge capital base and the bank could fail. And it appeared that advice was not really heeded at that time. That's the reason why perhaps some years later, the banks, even though recapitalized, all had a minimum of 25 billion capital base, you found that, unsoundness, resurfaced. That was observed during the era of Governor, Sanusi, Emir Sanusi, and that was the reason why some form of restructuring was done, during his, tenure. In other words, the lessons that could have been learned from such recapitalization is the need to accompany the recapitalization program with appropriate measures to address numerous factors that tend to cause ill health to banks. But it appeared that such factors have not really been addressed over time. So, and that's the reason why we still have, from time to time, symptoms of ill health of banks. And to the extent that some of them had to be merged during Governor Sanusi's era. And last year, we found a situation whereby one of the banks was so unsound that it had negative capital base, negative capital. And the central bank took a decisive, very decisive action to protect depositors by getting a new bank out of that existing bank. So invariably, there are always lessons that are learned from programs and policy implementation like the one we have. But then is the will there to actually do the right thing such that capital alone is not seen as the panacea for the problems of banks. Definitely is not the panacea. We must take cognizance of issues, in management, fraud in the banking system, irresponsible behavior on the part of some members of the boards and management. And of course, we also have, phenomena like internal and external shocks, unstable economic policies and conditions. Then, of course, if we tend to liberalize entry so much, then definitely that in itself creates problems. I know that's one of the issues one of the speakers mentioned, perhaps to liberalize. But liberalization, free entry, may not really be the solution of the problem. While we aim for optimal number of banks, making the number so large that they are uncontrollable, and then you now create an opportunity for distress in the system, that will not be permissible. So I will want a situation whereby the central bank would aim at an optimal number of banks that can exist in the Nigerian economy without hurting various stakeholders, depositors, investors, and so on.
Thank you very much, Professor Michael Banda. We'll get back to you again and in the course of the discussion. But at this point, let's take a break, and when we return, there are already reactions from our viewer. Join us at NTA GMN is the Twitter handle. We'll just keep them coming. We'll take a look at some of the ones that have come in the time being once we get back from this break.
All right, welcome back from that short break, and it's still Good Morning Nigeria live on the network service of the Nigerian Television Authority. As my colleague Blessing did indicate, we have a number of tweets that have come in. Let's quickly take some of them and then return to our guests. Ify, that is a Twitter handle. It's also at Eagle Square 2006. Same banks that are starving development and growth with their blatant refusal to give out loans to sole proprietors and entrepreneurs at single digit. You forgot that once the people stopped investing, growth would disappear.
Law Alpha C tweets, recapitalization of banks is a welcome development in order for us to know the health status of these institutions in view of many negative experiences.
Sani Michael Amakoje tweets, now, because of inflation that has set in over time, a need for recapitalization is definitely the way to go. However, what alternative job placements do we have? As some banks that might not meet the new capital adequacy requirements might fold up and also lay off staff. We don't have the opportunity, then another doom looms.
Akeju Olagbaji tweets, it sends wrong signals to vulnerable customers in getting the desired services. For me, it is not a must that all banks must be capable to undertake large transactions. What is important is the specific services tailored to meet the needs of customers. And those are the reactions we have gotten for the time being.
Yeah, well, let's return to Dr. Abdallah, Zubair Abdallah in our Kaduna Network Center. Dr. Abdallah, of course, you've also had the opportunity of listening to the other guests. I just wanted to play up again some of the points that were made in the past. after the consolidation exercise of 2005, there were complaints that it didn't seem to have been fair, that some parts of the country were denied the opportunity, and that the mergers and acquisitions that occurred simply just gave room to raiders, corporate raiders who swallowed up the small banks, and then the economy got consolidated further in the hands of a section or just one or two sections of the country. What's your reaction, and how might this be obviated in 2019 if the new CBN proposal starts rolling?
The issue of some sort of one region have an advantage over the other in terms of the emergence of new banks, newly recapitalized banks during Soludo's time, to me, is not the issue. The issue is truly that of, one, after the recapitalization, what happened? Banks went from office to office, begging salary workers to come and take loans. Even when they were unwilling, they were craftily persuaded to do that. So they applied, and some of these applications were not critically evaluated to assess the capacity of the potential borrowers to pay. That is one. And secondly, when eventually the loans were disbursed, there was no cooperative governance exerted in terms of following up, especially in the private sector, in terms of following up to ensure that the resources were spent for the purpose they were meant to be spent on. And over time, it was almost inevitable. I sat down and looked at it at that time, and I said, there is going to be a problem. No critical credit assessment, no exercise of corporate governance, and banks were just dishing out money. And like one of the discussants said, they squandered the capital sooner than later. And bad debts began to mount. Stress began to appear in the banking system. And then there was another need for either another round of recapitalization or some alternative way of getting the banking system to behave. So these are some of the central issues, sir. It is frivolous for me to sit down here and start talking about why is it that the North ended up with only one or two banks and the South ended up with many. We have many people who have the money in the North to invest in banks, but perhaps due to cultural or religious factors, they may not be interested in investing in banks because of usury problems, religious problems, I mean. Some people are not too comfortable even being paid interest or paying interest. So the window that could have been seized in acquiring or investing in new banks was lost, not because of the incapacity or lack of money across the Niger. No, it was more because of other cultural factors and the lack of interest. If you take a census of the people who invest in the capital markets, you will see that a lot of the Northerners are investing in capital markets because their religion and culture agrees with investing in business. But investing in a bank is something else. Remember, even the renowned Dangote once operated a bank, and then a few years along the line, he changed his mind. He focused more attention on other things, especially solid production. So please, I am not one of those who want to delve into discussing as to why or why not. There is a kind of disparity in the ownership of banks between the north and the south. I don't feel we were disadvantaged up here in the north. I feel that our people were just disinclined. They were not comfortable, some of them, in investing in banks. Rather, they would rather go and build flour mills, cement companies, and the like. Real production. Thank you.
Very much, Dr. Abdallah. Back to us in the studio. Professor Waleke, every one of you have raised your different concerns, and it will appear, okay, it's not just in what is the capital base now, but management issue, risk, or poor risk management, as well as some other indices that you have pointed out. Where and how should the CBN undertake what is proposing based on what you have raised?
Yeah, thank you. First and foremost, I want to recognize that, yes, concentration in the banking industry, a situation where you have just a few banks, dominating, has its own challenges, and one of which is the issue of, systemic importance. The chances that if something happens to one bank, there could be a contagion. It could also affect, the other banks, and then the economy will, could go down. So I agree with that, with that position, that there could be systemic risk. But that does not remove the fact that recapitalization, as has been rightly pointed out, is a necessary condition. It may not be sufficient, but it's a necessary condition. I don't subscribe to the idea of lowering the, entry barriers to the banking sector. Yes, I agree that the structure, if you move the structure from the monopolistic nature to, say, oligopolistic, where you just have a few, you remove competition, and that could also affect the kind of prices we get from the banking, sector. I was discussing with a friend recently in connection with this, and the person was telling me, why is the CBN governor, talking about recapitalization, a few years after we had the other one, whether is he looking for, some job to do or what? That the central bank should have faced the challenges in the banking sector. He talked about insider abuses, talked about, excess charges, unauthorized deductions and so on. And I looked at him and I said, these are even the justifications for the recapitalization, the proposed recapitalization. Because by recapitalizing, okay, what you do is to change the ownership structure of the banking sector. You move it away from family-owned, more or less. You widen it further. And what that does is that it helps to reduce the preponderance of insider abuses, the overexposure to directors, for example, and shareholders with significant interest. Significant interest is defined as a shareholder having more than 5% of the shares. So by the time you have big banks with diversified ownership structure, it helps in corporate governance. So many of the corporate governance issues, as I mentioned earlier, are usually associated with family-owned banks. And that is why, again, I will not agree to the view that we have to open our banking space, to the point where we can begin to have family-owned banks. Even now, as we speak, I think the structure, you could say, is also risk-based, in the sense that we have national banks, we also have regional banks. Wema Bank, for example, is not, to the best of my knowledge, is still licensed as a regional bank. So that tiered level, is also recognized. And we have microfinance banks. Recently, the central bank is talking about using Nistral Microfinance Bank, okay, to be sure that, there is easier access to credit. But what is important, again, to note is that banking is no more in an era of where brick and mortar is emphasized, where you must have banks all over the place, especially now that the central bank is trying to emphasize digital modes of transaction. So we need few banks that will be in a position to deploy some of these technology to ensure better and easier access to credit. So what we need to do now is for the central bank to step up monitoring and supervision. If you look at the prudential guidelines of 2010, for me, it's very comprehensive. Risk management, corporate governance, very comprehensive. It is for the central bank to put in place measures, consumer protection and the rest of them, to implement, what is there. So step up both on-site and off-site supervision of banks. And that will be easier if the banks are fewer in number. If you have so many banks, it creates more problems for the central bank. Even monetary policy transmission becomes also a challenge for the central bank. Yeah. You have fragmentation of banks in the economy.
Yeah, Professor Waleke, if you recall, before 2004, that was one of the excuses given, that the banks were too fragmented, there were too many, and CBN didn't seem to have the adequate personnel to undertake monitoring and supervision. It is something almost 90 banks at the time. Now they are 25 or thereabout, because you have some newer banks that have come up since the consolidation exercise. I'd like us to return to Johnson Chukwu in our Lagos Network Center. Mr. Chukwu, earlier, Professor Waleke did say that the major routes to recapitalization, if it becomes a policy of the central bank, will be through M&A, as well as the stock market. M&A, of course, for our viewers, that stands for mergers and acquisition. Tell us something. Professor Waleke says that it might help to reawaken and then deepen the capital market. The picture in 2004 isn't exactly the same picture that we have now in 2019, following the interregnum that lasted almost a decade, when the capital market went flat, as it were. And a number of these banks, some of them have, in a sense, the equivalent of what you might refer to as penny stocks. Might this be a good time, therefore, to open up the banking sector for recapitalization through, for instance, the capital market?
If the central bank comes up with a capital-based requirement that is beyond the current shareholders' funds of existing banks, then the banks will have to look for funding sources. One of the options that will be available to them is the capital market. You may see some of them coming to the capital market to do public offers. But you also have to gauge the level of economic activity in the country today. And if you have to do a direct comparison between 2004 and 2019, and in 2004, the economy was growing at more than 6%. We're dealing with an economy that is actually struggling at barely 2%. We saw a lot of investor confidence in 2004. Today, we have weak investor confidence in the capital market. So in as much as the capital market will present an opportunity for investment by any company that has a good offer proposal to investors, then the robustness we had in 2004 is not there today. Some of the banks that have value proposition will come to the market and raise money. Some others may not, just like what happened in 2004, where some banks tried to raise money in the capital market, but they couldn't get investors because they didn't have any value propositions to make. But I also must mention something. When you talk of raising additional capital, you have to look at return on equity. Today, the average return on equity among the top 6 banks is about 15%, although we have an outliner like GT Bank that has a return on equity of about 32%. So investors that are going to invest in new shares of these companies will recognize that there will be dilution in earnings, and the return on equity may not be as much as we are getting currently. So that might be a disincentive for investment in additional shares. Also, consider the fact that, when one of my colleagues over there was speaking, he said that the banks went about hawking credit because the economy did not expand as much as their capital base had expanded. So if the economy fails to expand, the banks will be goaded or compelled to begin to advance credit to sub-credit borrowers or borrower with weak credit history. And that will lead to an increase in the incidence of non-performing loans. Of course, we know the shortest route to a bank failure is non-performing loans. So in as much as you're going to look at the capital market opportunity to invest, to raise capital, but then the expansion in the general economy may be strong enough as to create opportunities for an increase in the earnings of the bank that are raising additional capital. If there's not such increase in the size of the economy, then the additional capital will be sub-optimized. They won't have outlets to invest in those additional capital, and that will lead to a depression in their earnings. So basic thing is this. When you talk of the size of the banking industry or the banks, you also have to deal with the size of the economy. No expansion in the economy, you're going to have high incidence of non-performing loans. That's, if you look at even what happened later to the financial crisis, it was the issue of what you call subprime mortgage loans, where the American banks had actually exhausted the opportunities for those who have strong credit and began to lend to those weak credit records, and those ones defaulted. That's exactly what happened in the country in 2006, 2007, and 2008 that led to the banking crisis, where banks advanced so much credit to people who had no capacity to pay. And then those credits failed, and then the banks suffered liquidity crisis that led to the intervention of the central bank, which couldn't even lead to the failure or the exit of a number of those so-called consolidated banks. And like I mentioned earlier, when the consolidation took place in 2004, 2005, the then CBN governor said the banking industry has consolidated to the extent that none of the banks can fail. But we saw failures as a result of high incidence of non-performing loans, weak governance standards, weak supervisory standards. So, in effect, the banks can raise money if they can maintain their current earnings, or they can actually up their earnings. That can only happen if the economy is expanding. If the economy is shrinking, they won't have the opportunity to expand their earnings. And if they do not come with a proposal that shows that return on equity will still remain strong or even be stronger, investors will not buy those shares. Investors will only buy shares that promise good returns on equity. And that's very core on where the banks can raise money. So we have to look at the totality of how we want to raise money. And my approach has always been, let's have a risk-based capital base. Currently, we have the regional banks that require about 10 billion share capital, and 15 billion share capital, that have cash reserve ratio, cash capital adequacy ratio of 10%. We have the national banks that require 25 billion in shareholders fund and capital adequacy ratio of 10%. Then you have the national bank, the international banks that have capital adequacy ratio of 15%. And then you have the systemically important banks that require capital adequacy ratio of 16%. The capital adequacy ratio would measure the capacity of the banks to meet its obligations. And for me, if you use that as a criteria, you will set threshold for banks at different categories. And you have banks that cut across different levels of capitalization.
Mr. Johnson Chukwu, thank you very much there for your analysis. And very briefly, let's return to Professor Mike Obanon. Professor Mike Obanon, one of our tweets did reference this issue, and we're coming back to it again. Well, you recapitalize banks to enable them to take on big projects, but the issue has always been lending to the real sector. And you're finding the central bank now doing some of the jobs that the commercial banks ordinarily should be doing. Will recapitalization, if undertaken from 2019 onwards, change the orientation of commercial banks in Nigeria to lend to the real sector and indeed those who are in a position to contribute to the growth and development of the economy?
Thank you very much, Kisley, for that important observation. Let me say that recapitalization will not necessarily change the attitude or orientation of the deposit money banks to lend to the real sector of the economy. It can, spur them in a way to the extent that they have adequate capital base. But importantly, what will need to be done to spur them to lend to the real sectors of the economy, the central bank is already taking some measures in that regard, because a good number of the banks are currently hobbled by a sizable proportion of non-performing loans, inability to get their money back from those who borrowed money, and then inability to even realize the collaterals. And the central bank has considered numerous measures to help in recovering loans, and also in ensuring that only people who are credible can borrow money. And once the various measures which the central bank is putting in place and implementing, are in place, then definitely the commercial banks may be encouraged, to start lending to real sectors. In other words, once the phenomenon of non-performing loans is seriously, substantially addressed, and new loans are repaid as and when due, and if they are not being repaid, the banks are able to realize the collaterals, then definitely that one will help. But on its own, large amount of capital will not spur them, not likely to spur them to lend more to the real sectors of the economy. What can further be done would be to use moral suasion continuously, which the central bank is already doing, to encourage them, and also to take measures, to block channels which they are now putting money into instead of lending money to the real sectors of the economy. For example, their active involvement in investing in government securities, which has adverse effect on the loans which they advance. Central bank at the last monetary policy, after the last monetary policy, committee meeting, announced measures, in that regard. So such measures that are being implemented by the central bank are complementing the proposed enhanced capital base, may reorientate the commercial banks, to move in the direction of performing their traditional functions, are trying to achieve their traditional mandate of financial intermediation, lending to the real sectors of the economy to aid growth and development of the economy.
Professor of Economics and also member Central Bank of Nigeria Monetary Policy Committee, Professor Mike Obano. Thank you very much for your insight. You joined us from our Benin studio. I'd also like to thank Professor Ochewaleke, Chairman, Chartered Institute of Bankers of Nigeria, Abuja branch. Thank you for coming on the program.
My pleasure.
Our appreciation also to Mr. Johnson Chukwu, financial analyst, who joined us from our Lagos studio. And we also like to appreciate Dr. Zubair Tajo Abdullah of the Department of Economics at Kaduna State University. Gentlemen, thank you very much for your